Okay, well, I am going to kick our webinar off this morning. Good morning to all of you and welcome. Thank you for joining us for today's webinar on the Coronavirus Response Act, COVID-19 Relief and Tax Benefit Opportunities. My name is Jason Castor, and I'm the Chief Business Development Officer for Parsons, Behle, and Latimer. And I'd like to welcome you to today's webinar in CLE. It's nice to have attendees representation from all of the firm's offices in Idaho, Montana, Nevada, and Utah. Thanks again for taking your time to join us virtually. We wish we could do this webinar in person, but given the current environment, we'll continue to do CLEs and webinars on important legal matters virtually until we can reconvene in person safely. So thanks again for being with us. Before I turn the time over to our presenters, I'd like to cover a couple of quick logistical and housekeeping items today. First, today's CLE is being recorded, and you'll be provided a link to the recording within 24 hours so you can share with your colleagues and teams. Second, we'd like today's webinar to be as interactive as possible, so please feel free to submit questions using the chat feature throughout our discussion. I know it's difficult in a virtual environment, but please don't hesitate to submit questions, and we'll do our best to address these during the presentation, and we have allotted time at the conclusion of today's presentation to address questions as well. And finally, for the purposes of CLE credit, you will receive an email from us tomorrow requesting your respective bar numbers for those of you that need CLE credit. Please provide us with this information, and we will submit this on your behalf. The email will also include a copy of today's slide presentation and a link to the recording of today's presentation. And with that, now I'd like to introduce my colleagues, Sean Monson and Ross Keogh. Sean Monson is a shareholder from the firm's Salt Lake City office and chair of the firm's employment and labor practice. He focuses his practice in employment counseling and litigation and real estate litigation and transactions. Ross Keogh is a shareholder from the firm's Missoula, Montana office, where he assists clients with business and real estate transactions and tax-related legal matters. And I would be remiss if I didn't let all of you know that both Sean and Ross, since early March of last year, have spent considerable time staying abreast of all issues related to COVID-19. Both Sean and Ross are members of the firm's COVID-19 response team and are incredibly knowledgeable on issues related to the Relief Act, the CARES Act, the PPP program, and the recent Response Act, which we're going to talk about today. So it's my pleasure to turn the time over and welcome in Sean Monson. Sean, I'll turn it to you.
All right. Thanks, Jason. I just want to make sure, can you hear me? Can you hear me?
We can hear you just fine, Sean.
Okay, great. So welcome, everyone. It seems when this first happened in March through June, that we were doing webinars once a week, and so I kind of feel like I'm stepping into a high school reunion, as it were, with old friends on this webinar. It's been a while since we've seen each other, but now we're picking it up again in the new year. So thanks, everyone, for joining. I really also want to say, with regard to this particular statute, it's been really interesting to me as I've talked with clients, I've talked with other people about this new Response Act that we're referring to it. And that is, when the PPP loans first came out with the CARES Act, people were extremely anxious and extremely interested in getting it. I was talking to multiple clients about, how do I get it? What do I do? I was talking with banks, as was Ross, I know, with his clients up in Montana. With this Response Act, a lot of people don't seem to know about it, or don't seem to know that this is an opportunity for them to take advantage of relief from the federal government, in addition to the first PPP loan draw that they had. And so I'm glad that you are with us today so you can learn a little bit about the PPP loan second draw program, see if it's something that you might be eligible for. And also, the Response Act has a number of tax advantageous provisions that change some of the tax code that Ross is going to talk about that really, again, people don't seem to be paying too much attention to, and I think it can really provide benefit to your businesses going forward in 2021. Okay, let's go to the next slide. All right, so I'm going to talk quickly about the second draw PPP loan program, and then Ross is going to talk about the tax changes and some of the things you might want to be looking at as you do some tax planning going forward. So on December 27, 2020, President Trump signed the Response Act, and the Response Act was an omnibus bill that had a number of different statutes within it. And the statute, or the act that we're going to refer to with the PPP loan, is called the Economic Aid to Hard-Hit Small Business, Nonprofits, and Venues Act. That was the name of the particular act within the Response Act that relates to second draw PPP loans. That was signed by President Trump on December 27, 2020, after some wrangling with Congress regarding the overall Response Act relief package, including the direct check payments that are being made to individuals of $600. There was some negotiation and debate about that. But President Trump did sign that on December 27, 2020. So it essentially created a facility for borrowers to get second PPP loans draws, and it also reopened the PPP loan facility for people who didn't take first draws. So it did two things. It enabled people to get second PPP loan draws, but it also enabled people who didn't get a first PPP loan. It opened the spigot back up to allow them to apply for a PPP loan. I'm going to talk today primarily about the second draw PPP loan program and the requirements for that, some of the similarities and the differences between the first PPP loan program or the first PPP loan program. So there's definitely some similar conditions to the first program. Again, no collateral is required. So these are really, really great loans that you can get. And there's a lot of advantages to getting these type of loans, even if they're not forgiven. The first advantage is there's no collateral that's required for these loans. You don't have to put up any real property. You don't have to put up any personal equipment. It's a collateral-free loan. The next real nice advantage of these loans is there's no personal guarantees. Your business takes out the loan. If your business takes out the loan, then you don't have to sign a personal guarantee, which is you're never going to get I shouldn't say never. It's very hard to get a loan for a business where you're not having to sign a personal guarantee. So that's an incredible advantage for these loans. Next slide. The interest rate is 1%, which even though we're in an environment of very low interest rates, that still is incredibly low. And the maturity period is 5 years. So you have to pay it off in full within a 5-year period. There's also the same affiliation rules. And if you were involved in getting a first PPP loan and had some analysis done with the affiliation rules, those same rules apply. There are some special rules that apply to industries that are within the NAICS Code 72 section, which are primarily a combination of food service industries. So there's some special affiliation rules that apply to those industries, but generally the same affiliation rules that were in play for the first PPP loan round are still in play now. Next slide. Okay, so what are the eligibility requirements? What do you have to do to be able to get one of these loans? The first thing you have to be able to show or do, as it were, is you have to have had a first PPP loan draw. In order to get the second PPP loan, you have to have had a first PPP loan draw. And you either had to have spent or expected to spend all of that first loan draw before the expected date of the second draw. So you have to spend all the money before that second loan draw date. It's available to businesses, it's available to independent contractors, nonprofits, and other various entities that the statute lays out. You have to, this is something that's a little bit different than the first round. The first round, as you remember, one of the gating issues was do you employ more than 500 or more employees? Because if you employ 500 or more employees, then you were not eligible for the first draw of PPP loans. They've decreased that. Now it is only companies that employ 300 employees or fewer are eligible for the second draw PPP loans. And again, there's special rules that apply to NAICS Code 72 entities There's essentially it's 300 employees per location. So that's a change from the first program. Next slide. And here is probably the biggest gating issue, and this is what most of you are going to need to look at to decide whether you are entitled or can apply for one of these loans. You have to have experienced at least a 25% reduction in top-line gross receipts for any quarter in 2020 as compared to the same quarter in 2019. So in other words, if you can show that between the third quarter of 2019, comparing the third quarter of 2019 versus the third quarter of 2020, you had a reduction in 25% of your top line revenue. This is not profitability, it's top line gross receipts. And if you can show that between the third quarter of 2019 or comparing the third quarter of 2019 to the third quarter of 2020, you had a reduction of 25% in those top line receipts, you are eligible to apply for one of these second draw PPP loans. The other way that you can do it, and this is not in the statute, it's in the regulations, but if you can generally show a 25% reduction in top line receipts in all of 2020 as compared to 2019, you're also eligible. So that might be an easier way to do it if you can show the annual reduction as opposed to doing it on a quarter by quarter basis. So that's probably the most important gating issue for applying for this loan is you have to show a 25% reduction in top line gross receipts. Gross receipts is defined as all revenue received or accrued. It depends on how you do your business accounting. So it's either revenue that has either been received or accrued from the sales of products or services, interest, dividends, rents, royalties, fees, or commissions. The nice thing about the second draw PPP loan is that for loan amounts under $150,000, the application process is kind of streamlined and made easier. If you have a loan, if your loan amount is under $150,000, all you have to do in applying for the loan is certify that you had this deduction in gross receipts. You don't have to provide the documentation supporting that certification until you apply for loan forgiveness. So it's very easy and very streamlined to get one of these loans if the loan amount is under $150,000. Next slide. What do gross receipts not include? They don't include things such as sales or other taxes collected with regard to, sales tax or amounts that you might collect on behalf of other people, for the services you provide, such as if you're a travel agent or real estate agent or you're involved in advertising agent or conference, where you're essentially taking other people's money but then using it for services that they're gonna receive. Those do not count as gross receipts. And this might seem obvious, but it wasn't obvious in the statute, but the regulations make clear that gross receipts do not include any amounts that you received in the first PPP loan that have been forgiven. That was actually a question that I had when I was looking at the statute. Is it doesn't talk about what about the first draw PPP loan proceeds and they've been forgiven. Do those count as gross receipts? I mean, under the definition of the statute, they probably would have. And I thought this cannot be what they intended. And the regulations, it's not really regulations, the final rule, the interim rule regarding guidance from the Treasury Department makes clear that the previous PPP loan proceeds you might have received that have been forgiven do not count as income when you're trying to determine this 25% reduction between 2019 and 2020. There are special calculation rules that are fairly detailed that I won't go into, but just know that if your business was not opened in 2019, you still might be able to apply for one of these loans, but there are special rules regarding the calculation, the reduction in income. Finally, entities that have permanently closed are not eligible for the loan, and that makes sense, obviously, because the purpose of the loans, similar to the first round, is to get money in the hands of employees to essentially help businesses pay and fund their payroll costs. So if the business is permanently closed, then it makes sense that they would not be eligible. All right, next slide. Okay. So how do we calculate the loan amount? If you had a first PPP loan, you'll recognize this formula. Essentially, you take 2.5 times the average payroll costs, monthly payroll costs that you are incurring. There is the one difference between this round and the first round is this round is capped at $2 million. So you can't get a second draw PPP loan for more than $2 million. But again, how you calculate the amount is you take your average monthly payroll and you times that by 2.5. And the average monthly payroll can be based on 2019 or on 2020. And how you do that is you take, your annual amount of payroll for either 2019 or 2020, you divide by 12, and that's your average payroll amount, and then you times that by 2.5, that's going to be your PPP loan amount. So it's a fairly easy calculation. Payroll cost has the same meaning as it did under the original PPP loans, so that if you calculated you had certain aspects of your payroll cost that you included in your first PPP loan draw calculation, it's the same calculation that you're going to be making. What you're going to be making as to what defines payroll costs. And similar to the first round, you can't count payroll costs that are over $100,000. The payroll costs you can include in this formula are capped at $100,000. So any compensation to an employee over $100,000 does not count. There is a twist in the new formula under the second draw PPP loans for industries that have that NAICS code 72. And you'll notice in this presentation that I've been talking a lot about this code, there was a real concerted effort to address the needs of businesses with this NAICS code, which is, again, food services and hospitality, because those industries obviously have been hit generally harder than other industries in the economy. And so if you are a business that has that NAICS code of 72, you are entitled to do the calculation not at 2.5 of your average monthly payroll, but at 3.5. So you can get a greater loan amount than other businesses can get. Next slide. So again, similar type of issues with regard to forgiveness. If you've got a first PPP loan, you'll recognize these points. So to be fully forgiven, 60% of the proceeds must be used for payroll costs. Other expenses that are eligible for forgiveness, these are very similar or identical to the first PPP loan program, are mortgage payments, rent payments, and utilities. So in addition to the payroll costs, you can be forgiven for mortgage costs, rent, and utilities. This statute, however, added some new expenses that are eligible for forgiveness. Now, again, you always have to have the 60% threshold for payroll expenses. So no matter what expenses you try to include, you always have to have 60% for payroll expenses if you're going to get full loan forgiveness. But in addition to mortgage or utilities or rent that was a part of the first PPP loan program, under the second draw PPP loans, you can also include operating expenses in that 40% category, property damage costs from riots or vandalism, supplier costs, and worker protection expenses such as PPP personal protective equipment. So this second draw program adds some costs that are eligible for forgiveness that were not present in the first program, and it gives you some flexibility. But again, the important thing to remember about forgiveness is you have to be at the 60% ratio of payroll expenses in order to keep full loan forgiveness. Next slide.
Hey, Sean, before we move on to the next slide, we've got a couple of questions that have come in, and I think it'd be timely to address those now. First question is, should the loan amount from the second draw equal the loan amount from the first draw?
Not necessarily. It depends on how you do the calculation. It doesn't have to be. It very well may be. But if you remember when they were doing those first first draw calculations, it wasn't necessarily based. Some people didn't do them on an annualized basis. So it very well could be, but it's not a requirement that it would be the same amount. And in particular, and then if you're in a 72 NAICS code, it's not going to be the same amount because you're eligible up to 3.5 of your average monthly payroll as opposed to 2.5.
Okay, thanks, Sean. Next question. For eligibility purposes, is there any requirement to show or prove inability to obtain financing or loans from other sources?
Yeah, there is not a credit elsewhere. As I recall, there is not a credit elsewhere requirement for the second draw PPP loans. They made that pretty, as I recall, I think that is specifically addressed. I will double check on that, and we can send out, when we send out this recording, if that is different, but I'm pretty sure that the regulations or the guidance made it clear that the credit elsewhere requirement that's normally part of SBA loans is not part of these second draw PPP loans.
Okay, thanks, Sean. There's a couple other questions, but let's move on the slide, and then we can circle back to those at the conclusion of your segment. Okay,
great. Okay, so logistics. How do we go about doing this? The portal for the SBA opened yesterday. It opened yesterday for essentially lenders that serve underserved populations. And so it opened yesterday for community development financial institutions, minority deposit institutions, certified development companies, and micro and intermediaries. So the loan portal opened up yesterday for businesses that are in communities and that are underserved. I suspect the portal is going to open up for everyone within the next few days. So talk to your bank if you got, and I would recommend, if this is not a requirement, but I think it's going to be easier, I would probably go to the same financial institution that did your first PPP loan, try to do the second. It's just going to be easier. They're going to have because on the application there's some information about the first PPP loan that you submit. They're going to have that information. It's going to be easier. It's not a requirement, again, and if you would rather go to a different bank to get the second PPP loan, nothing's going to stop you from doing that. Just from my perspective, I think it's going to be easier logistically. The applications must be submitted by March 31st, 2021. So there's a very, very short time frame, unlike the first PPP loan program where, there was the initial round of funding, and then they did the second round of funding, and it ended up being a period of several months. This is short. You've essentially got 2.5 months to try to apply for one of these loans. Next slide. Okay, so here's just a couple of things I thought were, there's always the statement that all politics are personal. There's a couple of things I thought were, maybe they're funny to me, but maybe you won't find them as funny, but very interesting kind of little issues that Congress put in this statute that you can see are very directed towards different political parties' preferences. One of the requirements is that any entity that is owned or in which a member of Congress, the vice president, or the president owns a membership interest in is not eligible for the loan. This is in relation to there was apparently some businesses that President Trump was involved in that actually got these PPP loans during the first loan draw. So that has now been squashed. News organizations have to certify that the PPP loan proceeds are going to be used as for part of the organization that's dedicated to locally focused stories or emergency information. So you can't direct these funds towards things that might be talking about national political commentary. And then businesses formed or owned by individuals from China are not eligible. So that is the PPP loan second draw program. I look at it and I understand, as I said, I've noticed that there's not a lot of, there doesn't seem to be a lot of interest or focus on this from companies that I deal with. I think this is a really important thing to be aware of, and certainly something that can help you navigate the remainder of this pandemic through 2021. So I will take a look at the questions on chat that came in, and then I will answer those. I'll answer those during the question and answer period after Ross is done. So thank you.
Hey, Sean, thanks a lot. And just one comment that's come in before we turn the time over to Ross from one of our attendees. They confirmed with their lender that the reduction in gross receipts of 25% in any quarter still applies if you had an annual increase in gross receipts. You only have to show reduction in one quarter. And our attendees felt this was very important to share with the group. So thanks for your comments, and thanks to all of you that have submitted questions. Ross, I'll turn the time over to you now to talk about ERC.
Well, thank you, Jason, and thank you, everybody, and for being here today. And Sean, thank you for getting us up to speed on the second round of PPP loans. I also just sort of want to acknowledge where we are. I think we first started here, maybe the first article about COVID-19 happened about this time last year. February is when it became really real, and we're all very close to having been dealing with this pandemic for a year. And I know a lot of people on this call that I've worked with or have otherwise seen. I mean, you definitely, I just want to express how phenomenal I think the business community at large has been in managing all of the issues that go with this. And so I'm hopeful today that whether it's the second PPP loan or this employee retention credit, that you'll be able to find some benefits for your business that'll help you I look forward. Because what we've seen when we have these sorts of stress events on the economy or on a business, is there's usually huge opportunity on the other side. People are rethinking their traditional paradigms. They're reevaluating how they do business. And we're very close to that moment. And so a lot of the businesses that I work with are trying, when they can find time, to look forward and are really excited about the future. And so just take that in mind as you go through the 25th time you've had a COVID infection in your office you've had to deal with, that there is going to be some pretty significant opportunity out there. All right, so with that, let me turn to the employee retention credit. Again, let's go back to the original CARES Act. This was included in the original CARES Act. It was intended to be a companion to the PPP. Businesses would look at the two incentives and then they would choose either the PPP loan or the employee retention credit based upon the business's size and needs. And what happened was that virtually no businesses at all used the employee retention credit, but yet it was pretty substantial. And so when they passed the Supplemental Response Act, they went back in time and made a few changes to the application of the employee retention credit in 2020 that may very well make this applicable to some businesses in 2020. And going forward, they made it significantly more attractive, and I think in most cases probably a better option for borrowers or businesses versus the PPP. There's still the choice, but you can also layer the incentives a little bit, and we don't yet know all the parameters around that. So this needs to be part of your discussion when you look at choosing a PPP is, would an ERC be a better credit for us, and how would it work and how would it fit? And so those are the issues that I'm hoping to talk about today. When you think about the credit, let me bottom line the number you're talking about here. It's $7,000 per employee per quarter in 2021. It expires on July 1st, so it's only the first 2 quarters under current law, but that is substantive. I mean, if you're an employer with 400 people that meet one of the 2 sort of gating requirements that I'll talk about here in a second, this is going to be dramatic to your bottom line. And finally, you can't take this credit and use it against wages that are stabilized with the PPP. So you've got to do some modeling to figure out which is the best and how to apply it going forward. All right, your gating requirements. There are 2, and you can qualify under either one. Similar to the gross receipts tests of the PPP, but a little bit easier to hit. There's a 20% decline requirement for gross receipts in a quarter to claim the ERC. So it's quarterly. So if your January gross receipts are down 20%, that quarter is going to be eligible for the ERC. You can compare, you have a broad ability to compare quarters. You can look at January 2019, or you can compare it to December 2020. Exactly how that comparison looks like and which quarters are available, there's some flexibility, and I'm a little bit curious how Treasury will determine that. But for now, if you're claiming this credit, and you can potentially claim the credit in 2020, The first step is map your gross receipts and start to do a comparison and see if you can find any quarters at all where you had a 20% decline from another quarter where the business was ongoing. The second gating requirement, and this is the one that I think that a lot of businesses are going to qualify under, is if you have a suspension of the business that is due to an order from a governmental entity that limited commerce, travel, or group meetings due to COVID-19. Now, there's a lot of elements that are packed in that sentence, which is taken basically verbatim from the statute. We have a number we have some preliminary guidance from Treasury that was issued in June that still appears to be applicable. So we're really going to unpack those elements in the following few slides. But just think about what that means, right? If your government said your bar or restaurant, for instance, can't operate for a week or 2 weeks due to COVID-19 in your community, that's going to make all the wages in that quarter ERC eligible. That's huge, right? Really significant as to how governments are responding. A couple other just changes that the supplemental response made where if you've thought about this credit previously, right, it used to be that the credit, you had to have a 50% decline in gross receipts. They've now reduced that only for quarters moving forward in 2021 to 20%. So it's a lot easier to hit the gross receipts bar than it was previously. The other portion is that the credit has now been increased. It used to only be 50% of employees eligible wages up to $10,000. It's now 70% of an eligible employee's wages up to $10,000. Again, those two changes are only for 2021. So let me unpack what constitutes a suspension a little bit more. The first thing is we need an order. It can't just be someone encouraging people to stay home or a government official. You actually need a health department, a mayor, a city, a county, a state, and or federal entity to issue some sort of order or proclamation that affects business. A business taking voluntary action is not going to count, even though it may be prudent and the right, reasonable move. It has to be an underlying order. The order needs to somehow suspend the operations of the business. It doesn't have to be a full suspension. It can be, shutting down a certain segment, perhaps a certain activity that the business engages in. An upstream interruption of raw materials, according to FAQ 31 that was issued by Treasury in June, will count as a suspension if that suspension is due to a governmental order. Restrictions on customer travel are not going to count. So a stay-at-home order for individuals would not be a suspension if it pertained to customers. Now, if the stay-at-home order stopped employees from coming to the business and carrying on critical functions of the business, now that may count as a suspension. And there is a note in the FAQ that sort of virtual, the ability to conduct business virtually, or if an employer sort of nominal disruption because they're able to go virtually, isn't going to count as a suspension. So, more sort of professional services, law firms, CPAs, and so forth, probably aren't going to qualify for suspended operations in most of the United States. Here are a few examples under current guidance that I think really help to color what constitutes a suspension. And these are taken almost verbatim from Treasury's website. So if we had, for instance, a physical therapy provider that obviously would typically meet with their clients, if they are able to do some of that virtually, but 10 or 20% of their services where they may use certain tools to help a client. And if that operation is suspended because of a governmental order, they're going to qualify for the ERC even though they're able to continue to conduct business. Another example would be a scientific research company that the government uses. Even though 80% of the work may be able to be continued, if they have some laboratory functions that are routinely part of the business that can't happen due to a suspension order, all of the wages of that employer are going to be covered by the ERC. And also an impact on a retail business, right? Restrictions in hours or potential occupancy restrictions. You can't have more than this number of employee or customers in your business at this time, and that is more than a nominal impact on the business, that business will become eligible for the ERC. And also, I think very interestingly, if there are major changes to the sort of time period that a business operates, such as a reduction in work hours to conduct daily deep cleaning, you have a 24-hour processing center and you have to suspend operations for an hour or two to engage in the deep cleaning due to governmental order, that business is going to become ERC eligible in that particular quarter. There is a limitation for large employers for qualifying for the ERC. If an employer has more than 500 employees, they can't take the credit against all of their employees' wages. They are limited to just those that are idle. And an idle employee is one that they are still choosing to pay, but they're not working due to a suspension or declining gross receipts. So if you are a large employer, you're subject to a suspension or you've had a gross receipt, but yet you've decided to maintain some employees on the payroll, even though they're not actively working, instead of having them go get unemployment. You're going to be eligible to take the ERC against those employees. And so I think this may change as employers look forward in Q1 and Q2. Instead of laying off or firing employees, they may choose to take the ERC because a large amount of their wages will be subsidized instead of pushing them onto the unemployment side. And so this can be a really effective strategy for large employers to really maintain their workforces and their culture through the use of the ERC. So the ERC is a credit, fundamentally. It's a credit against Social Security or railroad retirement taxes, which means you claim it on your Form 941. This is not a credit you take against your general income. It is a credit that's filed on your payroll tax forms, in particular Form 941. As you look back in 2020, if you feel like or you find that you may have been ERC eligible for a particular quarter, you can still claim, say, Q2 or Q3, right? 941s are quarterly filings on the Q4 941, which is due on January 31st. So employers really, before filing that form, need to take a canvass and see if there is any ERC eligibility in prior quarters. This is a quarter-by-quarter analysis, so each quarter somewhat stands on its own, and there's definitely some analysis work that the employer needs to do to find eligibility. Once you've determined if you meet either of the two thresholds in a particular quarter, gross receipts or a suspension order. And I would note, right, if you're looking at Q1, you don't know what your gross receipts are yet for Q1 until the quarter's done. So it's somewhat hard to plan around that. But you may already have a suspension order. So the suspension order might allow a business to know that they already in Q1 qualify for this, and then to plan around it, even if that suspension order maybe lifted them up from that. ERC is capped at $10,000 in wages per quarter per employee, so you have to really model and understand each employee's wages, and then you get to include certain things like employer health costs, and then you apply the 70% to determine the amount of the ERC. So as I said at the beginning, this is sort of a complement to the Triple P. And under the original CARES Act, it used to be that you had to choose between the two. Now you can still take both incentives. You just can't apply wages both to the Triple P and to the employee retention credit. How that's going to work for the second round of Triple P loans is a little bit of an open question. It's something that we definitely want to see some guidance on. But for now, it appears that, for instance, if you take the Triple P loan in Q4 and you decide to apply for you take the ERC in Q4 and you decide to apply for a Triple P in Q1, you would need to remove whatever wages you had allocated towards the ERC in Q4 from your Triple P base to calculate your amount of eligible Triple P. And then likewise, you could still take the Triple P or the ERC in Q1 along with the Triple P, but any wages that were stabilized, that 60% that you've applied the wages, sort of your base minimum, you couldn't claim an ERC against those wages. That appears to be the statutory framework. There's some questions exactly how that earmarking and gating is going to work, but I think that's a rough enough parameter for employers to start to think how they may dovetail these two incentives. So because the ERC is a credit against employment taxes, there's some particular issues and liability that employers should be aware of. If you've ever dealt with Social Security or other sort of trust fund payments, these are fundamentally payments that businesses are making on behalf of their employees, right? Social Security is a trust fund that is managed for the benefit of employees. It's a retirement fund. And because of that, Section 6672 imposes broad individual liability and penalties for those individuals outside of the business that fail to truthfully account for the payment of these taxes. Many of you that have worked in business are probably familiar with this rule, but if you are, quote unquote, a responsible person as determined under that code section, and that can include corporate officers, directors, bookkeepers, accountants, owners, and managers, you individually can be liable if you don't correctly report or file and remit Social Security taxes. That's a very, very different standard than when you file an income tax return on behalf of a business. And so these responsible persons, it turns out, are also individually and jointly 100% liable for any taxes that are not appropriately withheld and accounted for. Now, typically in most payroll processing, it's fairly simple, right? You count your wages, you make sure you make the deposit, and you file your Q1. There's not a lot of sort of complexity around filing a 941. But when you look at the ERC, since it's going to be on your 941, in the background, right, you have to make this determination, this qualitative determination of was I or was I under a suspension order? And I think that really changes the analysis for those in the payroll department about what level of comfort you have in preparing a 941 that may take a somewhat aggressive position that the business was under a suspension order, especially given the dollars that are involved here. It's important to note that the standard is willful, right, in determining whether these individuals are liable. What does willful mean in this context? It's not like we might see in criminal law where it's a deliberate malice act. It can just be reckless disregard. So we don't know what the case law is going to look like in defining reckless disregard in the context of 941 reporting and the ERC. But it would seem that there should be some level of documentation retained at the business that really walks through and maps out how that business qualified to take the ERC and the applicable quarter. So let me go through sort of an example, which I think really helps color how we see this working. So we have a restaurant. They got a nice PPP loan in April of 2020. That reflected about $100K in monthly wages. They used that to stabilize operations in Q2, and they've been sort of going along in Q3 and Q4. Pretty normal set of scenario that we're seeing across the business environment. And they're doing okay, right? Gross revenues are 80 to 90% of 2019, but they've just got all these complicating factors with the local health department. They wanted to close early at 10 o'clock. Table spacing has to be greater than six feet and so forth. They're still able to operate. They're still able to do takeout. Now, the IRS FAQs make very clear that this business, because those government orders are in effect, will qualify for the ERC. So looking forward, assuming none of their employees are over $10,000 in quarterly wages, they're going to potentially get $210,000 per quarter in ERC. Which is going to be way more than the PPP that they secured. Now the suspension order could go away in Q2, hopefully, right? We're going to get out of the pandemic, but at least for where it's in effect, they're probably better off taking this. Now there's a wrinkle in the way that the statute came out, and this is an area that I would love to see guidance confirming that we're interpreting this correctly. But it appears that they can actually go back, even though they took the PPP in 2020, and get at least 1 quarter's worth of ERC under the old under the old CARES Act rules in 2020. Now that's the 50% amount, not the 70% amount, and it's only a single quarter. But when they file their Q1 941, they should be able to claim $150,000 in 2020 ERC against those taxes. This is something to definitely watch. If you've identified that you're in a suspension or gross restraints when you file that Q1 941, to see if you may be able to go back and pick up a quarter in 2020, even if you took the triple P. So just sort of to summarize, if you've identified as a business that you may qualify for this credit in a particular quarter, we do feel that documentation is really important. And typically what that will probably look like is some sort of memo. You may develop that memo in coordination with your legal and tax counsel. It may actually be a document that is subject to attorney-client privilege depending on how you structure it. And it will really document the basis to claim the ERC. That would include, to a file orders, those in the memo as to how they address or impact the business, have census that is memorialized to be over 500. You document those employees that were idled and why they were idled as part of that preservation. Also, obviously, understand everybody's wages, and then coordination on how you're using triple P proceeds versus funds for the ERC. Now, this is not required to include with the 941 filing, but given the nature and the size of this credit, we feel like that there will likely be a lot of audits that will be going on, and so and this will further help those individuals that are part of the preparation of the 941 avoid being willful responsible persons and subject to 6672 penalties. Thank you.
Ross, thank you very much. Great job. As I indicated from the outset, we'd like to leave a little bit of time here at the end for any questions that you may have. While questions are coming in, I want to make note that you can reach out directly to either Sean or Ross for any questions that you have regarding PPP or the ERC. Their contact information is listed on the slide. Sean, while we're waiting for questions, any final takeaways that you might have for our audience?
I want to just confirm one thing. During my presentation, there was a question about the credit elsewhere requirement. The credit elsewhere requirement was an issue that came up with the first round of PPP loans, and essentially what it related to was the PPP loan program is just an extension of the existing 7A program of SBA loans. And usually under those loans, in order to qualify for an SBA loan, you have to demonstrate to the SBA that you don't have other avenues to get revenue. So it's called, you to get a loan. So it's called the credit elsewhere requirement. And there was a question in the first, when the PPP loan first round happened about whether the credit elsewhere requirement applied to the PPP loans. And it was not clear in the statute, it was not clear in the regulations. With the new guidance that just came out a couple of days ago from Treasury, I just confirmed that while Ross was speaking, the credit elsewhere requirement does not apply to these second draw PPP loans. So that requirement has been waived. Another couple of comments that I wanted to make that we didn't make during the presentation I think is helpful for people to know, and you might already know this. Another one of the big issues from the first round of the PPP loans was whether those loan proceeds that are forgiven would count as income or not count as income, but whether the expenses that you paid with those PPP loan proceeds could be deducted. So in other words, if you paid all those loan proceeds, those loan proceeds, you get them, you pay for payroll, you pay for utilities. Normally you could deduct those as business expenses. The notion that you could deduct those expenses also on your taxes was present in the CARES Act, but the Treasury Department's guidance suggested that you couldn't deduct those on your tax returns. The new Response Act makes clear that you can deduct those expenses. And finally, one other item that is another blast from the past is, as you recall, the first statute that came out in response to the coronavirus was the Families First Coronavirus Response Act. And that statute was the statute that required employers to give leave to employees who were affected by COVID, whether because of their own sickness, having to care for someone else who is subject to a quarantine order, whether to take care of a child whose school had closed. And as you will recall, that FFCRA gave you tax credits for those payments you made to employees for leave. Those tax credits have been extended to March 31st as well. Now, there's some ambiguity or some lack of clarity regarding whether the FFCRA requirements have been extended to March 31st. I think the better answer to that is probably not, and we haven't seen any guidance, but certainly the tax credits, if you do provide FFCRA leave through March 31st, 2021, you can claim a tax credit. So I guess the final thoughts I would have is if you are eligible for either the PPP loan or the ERC credit, take advantage of it. I mean, there's lots of opportunities right now in tax planning and also through these PPP loans to help your business get through 2021. You know, but we all see light at the end of the tunnel. I was just talking to my wife this morning, and the CDC has come out essentially with statements that a lot of people at CDC think that we'll be back to some semblance of normalcy by the summer. And until that happens, and we'll take a look at these PPP loans, take a look at the ERC credits, see if you're set yourself and your business up well for 2021.
Thank you very much, Sean. Ross, any final comments for you?
Yeah, I think to Sean's point, right, that there was a lot that was in the Supplemental Response Act, and we haven't covered, all of it. We just sort of picked these two very particular things. One other piece that was in there that employers will want to take note of is, the 100% expensing of business meals going for the next 2 years. That will have some impact on a lot of businesses, so something to keep in mind. The other piece of legislation that is worth putting on everyone's radar that passed, or that was where both Congress and the Senate overrode the president's veto, was the Defense Appropriations Act. And that occurred on January 1. And tucked inside the Defense Appropriations Act is our anti-fraud provisions for individual businesses. And what that will mean going forward, and we're going to have to see regulations, and there's a 2-year implementation period. So, don't put this on your to-do list in Q1, is that a lot of small businesses in particular, those with less than $5 million in receipts, and any entity whatsoever, even if it's just a holding entity, they need to register with a federal database and provide information about all of their equity owners. Again, until we see regulations, we don't know how that process is going to work. But this is going to be a pretty significant impact and compliance obligation for businesses moving forward. And again, that was in the Defense Appropriations Act, not the Supplemental Response Act, but that was that other piece of legislation that came through on the eve of 2020.
Great. Thank you very much, Ross. And before we conclude today, I wanted to just circle back on a few items that I touched on at the beginning of the presentation for those of you that may have joined late. For the purposes of CLE, for all of our clients and friends from Utah, Idaho, Nevada, and Montana, we will be sending an email within the next 24 hours requesting your respective bar numbers. We will submit CLE on your behalf. This email will also include a link to today's webinar recording, and it will also include the slide deck prepared by Sean Monson and Ross Keogh. I'd like to extend a huge thanks to all of you for taking time out of your morning to be with us for today's webinar. We appreciate the partnership that we have with you and your organizations. And I'd also like to extend a huge thanks to Sean Monson and Ross Keogh for their time and effort in putting together today's presentation. And as I mentioned, both of these individuals have spent countless hours. I can't even begin to imagine how many hours since early March of last year when the pandemic first took over, devoting a lot of time keeping our clients and friends of the firm abreast of issues related to COVID-19 and how these issues may impact their business, how these issues or these acts could potentially benefit your business. So Ross and Sean, a big thanks to both of you for your tireless efforts. And in closing, and then my final comment, thanks again to all of you. We wish you and your families all the very best. Stay healthy, be well, and please don't hesitate to contact us if you have any questions that we could potentially help you with. And with that, thank you.
Thanks, everyone.
Have a great day.